Well, let's see. What are we going to do next here? You want to do, I guess, Qualcomm,
Qualcomm.
is what we're going to do next. And Qualcomm, Qualcomm, I've always been in favor of this company, like a lot of people. It's a San Diego-based company, so I always want them to do well. We've had our concerns on it, but we'll go over some numbers, talk about what we're seeing here. They are in the semiconductor industry, only 2.5% short on the float side, 81% institutional owned. PE ratio looking pretty good, 17.5 versus 56. We do see price to sales 4.7 versus 15.2. Price to book value also good, 7.2 versus 12.7. And price to cash flow 16 versus 41.2. No PEG ratio, unfortunately. I would like to see a PEG ratio, but it's just not there. Over the last year, their earnings are up 15.9%. That sounds very good, but the industry was up 55%. Sales for Qualcomm up 11%, also very good, but the industry up 57.3%. Now, the 5-year growth rate on the earnings from the analysts for Qualcomm is a negative 4.6%. The industry is a positive 42.6%. We do say they pay a decent dividend, 2%, using 33% of their earnings to pay that out. And then look at the balance sheet here. We got a current ratio of 3.2 versus 3.3, so good liquidity. Debt to equity, not bad at all, 0.5 versus 0.3. We do see a net profit margin for Qualcomm of 26.8 versus 24.5. That's a positive. Return on equity is 42.6 versus 58.8. And then we have free cash flow, $11.6 billion. A lot of money, but the industry's at $43.7 billion. So they're kind of underperforming there on their cash flow side.
Well, I mean, shoot, that probably includes NVIDIA. And NVIDIA, right or wrong, I mean, they are a great business. I say right or wrong. Expensive or not,
right.
It's a great business. And, the thing you look at is NVIDIA's got now a $5 trillion market cap. Qualcomm's got a $190 billion market cap, so NVIDIA's free cash flow better be a heck of a lot better than Qualcomm's. But, this company was interesting. The reason we wanted to pull this out was, they had a big surge this past week. They actually made the announcement that they were going to release new artificial intelligence, there's that word, AI accelerator chips to target the AI inference market. The announcement marks a shift from Qualcomm, which has so far focused on semiconductors for, again, that wireless connectivity and mobile devices and not massive data centers. Now with these new chips, Qualcomm is going to be competing against NVIDIA and AMD's GPU offerings and adding competition to that AI semiconductor market. It looks like the AI 200, which is a Qualcomm chip, will go on sale in 2026, and then the AI 250 is planned for 2027. So concern here is it went up a ton.
Yep.
But there is no guarantee that they effectively take on NVIDIA, which obviously has a great product.
I mean, you're the little guy coming in and take on the big guy. And I think when that day, I think the stock was up, Qualcomm was up, I think, 20%. Normally, when you get competition on the market, the other players drop. Well, AMD and NVIDIA went up that day. So you never want to get into a competition war, especially with the big players. I don't know why that. And again, this reminds me of the .com and bust. I got more numbers to cover. But if you said .com, your stock went up. Now, if you say AI, stock goes up.
Yeah, without any fundamentals behind it. There's no fundamental news on this. It's just like, we're going to do this. Oh, cool. Yeah, we're going to buy it up 20%, maybe like a 4 or 5% bump. I'd understand because there is some opportunity there, but a 20% bump just seems outrageous. And I think the market kind of agrees because the current price here for a Qualcomm is now $180.90. The high that it hit on Monday was $205.95. Oh, wow. So it's down about 12% from that high that it hit just on Monday. The 52-week low, though, if you bought then, it was $120.80. So you've done well from the low. But again, if you got sucked into the hype on Monday, you are now down likely on the week. It's, again, why trading doesn't make sense. Going forward, though, for Qualcomm, you go to September 2026, estimated earnings per share here, $12.08. It gives us a target sell price of $200.53. Forward PE still around 14.5 times, 14.5, 15 times. So, I mean, it's not overly pricey like a lot of the other tech names, but I wouldn't say it's a great value at these levels either.
Yeah, and there's other issues with Qualcomm. I mean, they do have, China, big part of the market. China came out and said they can't do something. I forget what it was, but China said, nope, can't do that. We know that next year they lose, I think, $2.7 billion.
I think it's 2027.
2027?
I believe so.
Okay, I was gonna say I thought it was late 2026, but we'll say another year from now, somewhere around another year. That's still not good to know you're going to lose almost $3 billion of revenue. I mean,
from Apple.
yeah, from Apple.
Yeah.
But even with that, I mean, still, it's just like, you look at, okay, so now they're coming out with these AI chips. Maybe it works. Maybe it's great. I think with Qualcomm, they're a great company. I think they can make it work. But will it really add that much revenue to the situation? I don't know, because now that's a third big player in the AI chip industry, and maybe they can't make it.
Yeah, and it is the Apple Qualcomm modem supply agreement is set to end March 2027.
Okay.
And, this is kind of going out there a little bit, but again, patience is important. We were actually looking at Qualcomm earlier this year, and again, you might miss it, but I kind of would want to wait until this deal ends, and you might see that stock go higher. But I think that is, as you said, a huge risk. And they have different product lines and business lines to hopefully displace that growth. But that's a lot of growth that you got to have to displace a potential big relationship like you have with Apple. So I think, to be fully transparent, is we looked at Qualcomm earlier this year and we held off on it because of the China risk and because of this Apple risk.
Yeah, I mean, I remember the number said yes, and we were so excited. Like, yes, I think we were going to buy it below 140. Like, the number said yes, and then we saw that. And again, right now with China, they're a big part of their business. They're not a friendly trader, and I'm sorry. I want to say I thought the number says 52% of business comes from China, which not a favorable partner to play with. So
yeah, and the chips are always very interesting because it's not like they're selling the chips to China, but they're made in China, and the U.S. buys them from China. So then it shows up as a Chinese sale. And yeah, here it is. China accounts for approximately 46% of its total revenue.
Yeah, that's not good. I'm sorry. And I want to like it. I want to be part of it, but I just got to be logical here. We'll see how this thing plays out. Maybe it plays out great, but right now, not so much.
It's a risk.
Big risk.
And trying to reduce risk, and that's a big
Yeah,
risk that
yeah.
I don't know if I'm comfortable with.
Yeah. So